quarter and full year reporting season for those firms with a March period end is upon us in both the UK and the USA, and banks will be centre stage on this side of the Atlantic in the coming week. Lloyds ushers in the first quarter results season for the quintet on Wednesday the 24th of April. Barclays will be next up on the 25th, followed by NatWest on the 26th, with the Asia-centric lenders, HSBC and Standard Chartered, due to report the week after on Tuesday the 30th and Thursday the 2nd of May, respectively. Now, the banking sector has shown improved performance in the past 3 months, perhaps buoyed by the view that the worst is over for the UK's economy, at least in the case of Barclays, Lloyds and NatWest, and perhaps buoyed by the hope that China is also about to show improved momentum as well, in the case of HSBC and Standard Chartered. Helped by the recent good run, the FTSE All-Share Banks Index is up by 13% over the past year. That leaves it to near a 1 and 5 year peak, although the benchmark is still no higher than it was in spring 2009, just as the world was staggering out of the great financial crisis. Now, 2023 was actually in many ways a pretty good one for banks. No major scandals to force compensation payments, fatter net interest margins after a series of interest rate rises from central banks, and no recession, so no major increase in bad loans, and that was all coupled with good cost control. The question now is whether 2024 and 2025 will be better, the same, or worse. As we head into the first quarter results for 2024 at least, analysts seem fairly cautious because aggregate profit forecasts for pre-tax income across the big five, well, they're seen as coming in flat to down this year and next. For Lloyds alone, stated pre-tax profit for the year is expected to drop to £5.8 billion, down by a quarter from £7.5 billion in 2023. And that's due to lower interest income, higher legal costs, thanks to the Financial Conduct Authority probe into discretionary commission arrangements in the car financing market, and also higher loan losses. We're going to look at Lloyds specifically here, as that's the first big bank to report, but the themes and numbers to watch will be the same across all of the big five for both Q1 and any guidance for the rest of 2024. And those themes are namely loan and deposit growth, the trend in net interest margin, the trend in loan losses and asset impairments, any litigation and conduct costs, and cash returns to investors. Now, to quickly take those in order for Lloyds, loan and deposit growth was pretty weak in 2023, perhaps as a sign of competition from established and fintech rivals. The second number, net interest margin, is where the combination of competition, an apparent end to interest rate increases from the Bank of England, and political and public pressure may mean the peak is already behind us, and that will take a toll on profit. In the fourth quarter of last year, net interest income at Lloyds was £3.2 billion, down from a peak of £4.4 billion in the fourth quarter of 2022. The third number to watch is loan and asset impairments. A year ago, Lloyds booked charges of £243 million in the first quarter, and analysts expect £280 million this time. Overall last year, though, Lloyds' so-called asset quality ratio, the percentage of total loans written down as sour, was just 0.07%, very low indeed, and Chief Executive Charlie Nunn has guided the market to expect a more normal figure of somewhere just under 0.3% for 2024. After that, analysts will look to litigation and conduct costs. They had been modest until Lloyds booked that £450 million charge relating to the FCA investigation into car financing late last year. Now, all of those figures will shape the headline pre-tax income number. For Lloyds specifically, in the first quarter, consensus alone is looking for £1.6 billion of profit. That's down from £2.3 billion in the same period a year ago. Finally, analysts will look to cash returns, as indeed will shareholders. Only HSBC of the big five pays a quarterly dividend, so there might not be too much detail here. But each of the big five is currently running a share buyback scheme. Lloyds returned £2 billion to investors via this mechanism in 2023, and analysts expect a similar figure in 2024, and that adds to a dividend per share that will be worth around £1.9 billion. Add those two together, and cash returns are expected by analysts from Lloyds to equate to 12% of the bank's current market capitalisation. Thank you for watching. I hope all of you and your families are well, and I look forward to seeing you again next time.